All right, well, thank you for sticking around for this, and excited to chat with this group here. Centralized versus decentralized stablecoins. I think there's a lot to unpack here. We've got a great set of panelists here. We've got Guy Young from Ethena, Chris Carapola from Curvance, and Nick Van Eck from Agora. Just briefly, if you guys want to give just a description of your project, Nick, why don't we start with you?
Nick, founder and CEO of Agora. We launched a new US dollar stablecoin. What we're trying to do is build a credibly neutral, institutional grade US digital dollar that partners with every business, whether it's a fintech, DApp, whomever. We want to share the majority of the net revenue on their platform with them and have an open partner model versus the traditional exchange-backed ones like USDC.
Chris Carapola from Curvance. We're kind of an integrated DeFi application. So we unify things like DEXs, money markets, cross-chain composability, all these different things together and support the full range of assets. So that's everything from interest-bearing stablecoins, centralized stablecoins, LP positions, whole 9 yards. So working with a lot of these gents and many more.
Hey everyone, my name is Guy Young, the founder of Ethena. We issue a synthetic dollar. It looks quite different to the product that Nick's bringing to market, just in terms of the construction and the backing that sits behind it. So the basic idea here is that you're taking crypto collateral into the protocol and then delta hedging that collateral using derivatives. That enables you to then issue a dollar against that collateral, which also captures a pretty interesting yield from both staked ETH returns and then also the basis within the futures market. We came to market at the beginning of this year, around late February, and grew to just over $3 billion in the 6 months following that. And yeah, excited to be here with these guys.
Awesome. Well, I guess first things first, going with the title of the panel, thinking about decentralized stablecoins, I think like everybody, first thing you think of is probably makers die. Rebrand aside, just thinking about their growth, despite how much growth they've had, if you compare them to a USDT or a USDC, they're still much smaller. So the question kind of is there room for decentralized stablecoins to grow as big as what we see with centralized stablecoins, and how do they do that? Guy, maybe we'll start with you.
Yeah, might just start on the definitions, because I think decentralized versus centralized is quite a gray area when we come to defining it. So I think maybe a better way to frame it is just on-chain versus fully centralized off-chain stables. And I think the problem that actually Maker came into much before now was actually just the CDP model that they had when they were fully decentralized with just ETH was just a fundamentally unscalable model, because it required a demand for leverage on ETH as sort of the input into how large they could scale. And I think any asset that's not linked to US Treasuries or actually just having dollar backing is eventually going to come into that problem, because fundamentally the demand for dollars is just so much larger than the demand for leverage. And so yeah, I think the basic answer here is that you can never compete at the scale and size of USDC or USDT unless you have some form of dollar backing actually sitting in your product. I think it's really a question of where do on-chain stablecoin issuers actually decide to go and attack market share, because I think the size of DeFi and the opportunity there has been pretty much captured by Maker and then new entrants who have come in. And really the growth that you see from USDC and USDT has been driven by a lot of the activity that you see on centralized exchanges as trading collateral. And I think to the extent that they don't move out of their focus on just pure DeFi, it's going to be pretty hard to grow to that size.
Yeah, thanks. No, I think that was a great answer. And maybe instead of just asking the same question, thinking about just newer stablecoins that are coming up, Nick, you've been working on Agora. How do you think about kind of entering this market, and what do you kind of see as your biggest growth vector?
Yeah, I think for us, and Guy maybe touched on this a little bit, is we have a much broader aperture that we go after, right? So it's not just on-chain collateral in DeFi or use in DeFi or use as a quote token, but also B2B payments, P2P payments. And so we view ourselves as kind of the dollar checking account. But for us, what we're doing to start is actually choosing to go where the puck is going. So we launched on ETH about 6 weeks ago, and Avalanche about 2 weeks ago. We deployed a SWE earlier this week, and focusing on chains and new ecosystems, and a lot of these higher throughput chains to really drive our growth in the early innings. But beyond that, it's going to centralized exchanges, fintechs, dApps. All of these people who use USDC, USDT today, but ultimately, drive that value back to Circle or Tether. Whereas with us, we'll sign an agreement with an application, or a decentralized stable. So my co-founder Drake was the lead dev at Frax. We work very closely with them, and we'll be their fiat coin partner and saying, hey, we'll share income with you for services that you provide to us. And in Frax's case, right, they had 300 million of USDC, and so that can be really meaningful. We could work with companies like Ethena as well, and ultimately, having that open partner model and going to all these ecosystem participants and saying, we want to be your stablecoin partner. And today that doesn't really exist for centralized players because you just have the duopoly of USDC and USDT, and we view them as really rent seekers.
Yeah, got it. And then Chris, I mean, given you're not really working on a stablecoin, but you're thinking about different types of collateralists, how to kind of bring more economic utility maybe to some of these stablecoins. Like, where do you kind of see like centralized versus decentralized stablecoins fitting into what you're doing?
Yeah, I kind of view us as like demand side. If these guys are supply side, then we're like the consumers of those stablecoins, basically. So, from my perspective, there's really two things that are important: is the liquidity factor, like how deep is the liquidity? If we need to liquidate people, if we need to, deploy liquidity externally using that stablecoin, so on. So I think that in general, you typically see larger liquidity depth, capital efficiency, whatever you want to call it, for centralized, or these kind of like more nuanced, like tokenized strategies like Ethena and such. Because if you look at decentralized, like pure decentralized, over collateralized CDP positions, it's not a one-to-one capital, efficiency layer, I guess, if you want to think about it as like the collateral versus the stablecoin outcome. So that just means you're getting less bang for your buck, right? It means that there's also going to be less demand for those things, which means you need a higher APR associated with that to make up for that difference. So it's just, I would say, better to work with the Agoras, the Athenas of the world than these kind of more bespoke, CDP models and such. There's also like the cross-chain side, right? Like a lot of the solutions these guys have built has been more around like unifying that liquidity, being able to burn on one side, mint on another, and so on. And that's really important for us as people want to rebalance to do things like liquidations or capture APRs. You said like, capital, like how do you get yield on those stable coins? How do you capture, value being in those tokens? That kind of composable nature is really attractive for us versus just being on one chain.
Yeah, and as we kind of think about more centralized stablecoins, like you think about USDC, you think about USDT, you kind of look at the volume of USDT across the space. You guys going to catch up? Like, how do you kind of think about competing with some of the volumes these guys are showing?
Yeah, I think actually the volumes on Athena's dollar is actually pretty low relative to the size of the market cap, and I think that's more of a function of actually the use case of Athena's product versus those. So Athena's USD has a pretty high opportunity cost. If you're going to be putting that into an order book or an AMM, you're not earning the embedded yield that's actually being produced by Ethena. And so to actually get or incentivize people to do that and use it as a trading pair is quite expensive, especially from the user's perspective when they could just sit in the yield-bearing product itself. And so I think the use case that we've seen the most traction is actually the collateral piece within DeFi, where you can use it as money Lego to do new and interesting things on money markets. But then most interestingly, I think it's the collateral piece within CeFi. We came to market with a pretty innovative, I think, product launch with Bybit, where you have USD capturing yield as your collateral while you trade derivatives. That grew to just under $450 million in size in just over a month. And I think to us demonstrates that actually what users are wanting out of this is less of something to trade in and out of a BTC and ETH, where those pairs are just extremely liquid and hard to sort of displace USDT. And instead, it's actually just saying, we're improving your capital efficiency while you trade, and I think that's a compelling enough sort of use case versus those other products.
Yeah, for us, it's going to be a multi-year journey for sure. The way that I like to think about it is sort of old buckets of liquidity and new buckets, right? So there's new centralized exchanges, new chains, new DEXs that launch every single day. And so it's really easy for us to go and compete against USDC and USDT before those venues have launched and sort of win that business over, right? And so in those areas, we're actually seeing a tremendous amount of success very early on because this is just a better model for that business, right? they're actually capturing the value of the stablecoin that's sitting on their platform. And so we'll start to see our volumes take off there over time. Going into Binance and trying to compete with USDT liquidity is not happening anytime soon for us. And so we're really focused on this two-pronged approach, but I think the newer venue approach is going to be much, show success much quicker. And then working with some of the older venues like, the OKXs, Bybits, Krakens of the world, and chipping away at share over time. But I think that's going to be a much longer game. And I think there will be a tipping point where we come close to sort of USDC liquidity, and then we just topple them, and then we'll march up that very large hill to try to compete with USDT. But I think it'll take many years, and maybe we don't actually ever surpass them, and they kind of be the global liquidity layer. But that's how we think about the approach.
And then Chris, like in terms of growing Curvance once you guys launch, what are you primarily looking at? I know you're some structured products, some stable coins, but are you kind of looking at that longer tail, and is that where the growth is going to come from, or are you kind of centralizing it in like kind of the 80-20?
Yeah, it's a good question. I think for us, it's really about we have a large range of we could really support any asset out there. So it's a wide net we cast, but we actually want to take fewer outsized bets. So it's better to work with people that one want to work with us and two have their own growth prospects, such that we could kind of grow together, right? I think in general the industry is so new. There's not that many entrants in general. And the kind of future state for crypto, for DeFi and such is we're going to be growing a lot more, hopefully, anyway. So I think for us, it's about finding people we like working with and building things together. So that's like if that's structured products with them, if that's just like the kind of naked assets itself, we can go down those paths, and then it's about doubling down on winners, right? So we can try a lot of things. We have been very fortunate to build a wide network. I imagine some of those initiatives are going to be very successful, and then some of them are going to be less successful, right? So it's about doubling down on your winners and just being nimble, I guess, as chains launch, as products launch, as the industry matures, making sure that we're not asleep at the wheel, and making sure that we can grow with it.
I'm going to shift gears here just a little bit. I think this is something that we all think about no matter what we're doing, but it's kind of the regulatory environment. How do you guys think about navigating that? Just like, is that a hindrance to growth? Are there changes that need to be made in regulatory, or how do you think about that now? How about you, Guy?
Yeah, sure. I think the first step that we took is we had no access to the US, TBD with how that sort of like changes post-elections, but I think from our perspective, it's just too high risk to sort of interact with users there in particular. I think Mika sort of rolling out did give a bit of clarity, but I think is a pretty unworkable framework for a lot of issuers who are sitting in Europe at least. But we have made a bit of progress there around actually getting listed as something that doesn't look like USDC as an e-money token, but more of an asset reference token. So that's one positive sort of advancement that we've had over there. But yeah, our approach has generally been set everything up within Ethena to be maximally flexible so that if something does sort of change, you have the ability to actually respond and sort of change the product to it. So in particular, the contract that captures the yield within Ethena is fully upgradable and can sort of be adjusted as required if there is sort of a change in the way that regulators want you to sort of handle that.
Nick, what about you?
Yeah, we actually have MTLs in the United States, but are not serving US customers or businesses just because for us it's just not worth dealing with the United States now as like a primary market. Mika did certainly clear things up, although as Guy referenced, there's some issues around it, right? So one of which is if you offer a stablecoin there, you have to keep it in bank deposits, or the majority of the assets in bank deposits. We saw why that doesn't really work with Circle's DPEG. Obviously, they kept $3.5 billion at SVB. SVB went under, and that impacted their business. With us, we keep all of our assets in overnight reverse repo or short-dated U.S. Treasury bills, and so securities. So ultimately, our counterparty is the federal government of the United States, which I think is a much better counterparty than a regional bank. But we're looking at regulation in Bermuda, Singapore, and Hong Kong also has a framework. So there is being progress made around centralized issuers. But for now, I think the United States is probably not the best place to go until there's federal legislation on stables, because federal government in the U.S. is king.
Yeah, as a US-based company, we think about that a lot as well. So being that we're in Seoul, feels like appropriate to ask. We're a few years out from UST and Luna and kind of everything that happened there. We've seen a lot of retros. We kind of all know the story. What can we learn from that? And what should we take away from that? Chris, why don't we start with you?
Could you speak on that a little bit more, just for the question there?
Yeah, I mean, we kind of saw the rise and fall of UST and Luna. We saw different mechanism design choices made. We saw different types of actions being taken. Like, if somebody wants to, replicate that model or, kind of do it, I guess, differently, what should they be doing differently?
Yeah, I think in general, algorithmic stablecoins and products like that run into a whole host of issues. Like whenever you have like high volatility, whether it be like liquidity events, like either liquidity drying up or flowing in, like it could create a lot of downstream issues. So I think there will be many attempts at Luna again under different names and kind of new coat of paint, if you will. But I don't think that at the end of the day they're scalable enough and sustainable enough to really stand the test of time. I do think that, people are always building really cool things in DeFi and crypto in general. And I think that we're going to see new mechanisms come out. Are any of them stable? I mean, I guess time will tell, right? But I think from our perspective, like we want to go for like the, safest, most scalable products first. And, we'll look at these like more, like cutting edge, bleeding edge, algorithmic or other novel designs with trepidations, but obviously with open ears as they build.
Guy, how about you?
Yeah, I think they clearly don't work, and I hope people don't attempt them again.
Agreed.
I hope that's obvious. I think, a couple lessons on our side, maybe one negative and then one positive was I think there has actually been a tone difference in founders this cycle versus what you saw with Doe last cycle, where the approach then was whenever you had sort of criticism or request to just provide transparency around things, it was sort of shut down in an extremely arrogant sort of way. And I don't think we sort of see founders behaving in the same way this cycle, which is actually pretty healthy, where there's reasonable introspection into how the mechanics of something work. And I think there's just much more sort of transparency and open discussion around those things, which is a really good thing. One piece that we did take away from Luna, which I think they did a good job around, which I know sounds strange to say, is actually the way that they thought about actually building an ecosystem around their product, because really they issued UST and then were quite thoughtful around what are the apps that actually consume dollars and actually went out and sort of built that themselves. And so I think this is a bit of a theme where for on-chain dollar issues in particular, you actually need to be quite thoughtful around what are the types of financial applications that you can actually try and build around your product to build an ecosystem on it. And I think that that's just one piece that we're sort of working on at the moment at Ethena, which is thinking about moving from a single asset issuer to more of a platform that others can build on your product. And I did think that that was one piece that they did reasonably well.
Yeah, actually, we had a conversation maybe like 6 months ago, and you said something that has stuck with me to this day. You basically said, I want Gauntlet to look at Ethena. If you guys tell me it's not going to work, I'm not going to keep doing it. I'm not trying to build something that's going to blow up. And I thought that was just like a really, I mean, it seems odd to call it a mature statement, but if you think about founders in the last cycle, that's not the types of things they were coming and like asking. They weren't saying like, come tell me this isn't going to work and I won't do it. They were just saying, this is how it's going to work and it's going to work no matter what.
Yeah.
It seems quite consistent actually in crypto that we think that economic laws and gravity and stuff don't really apply in this like weird sort of space that we're in. And I think we learn the whole time that they do apply just like anywhere else. So yeah.
Yeah, absolutely. All right, we've got a minute left. Why don't we just round robin? You know, if you want a closing statement on stablecoins. Nick, why don't we come back to you?
Yeah, I guess maybe just start with the title, centralized versus decentralized. I don't actually think it's one versus the other. I think there's a lot of ways in which they can work together. We're working very closely with decentralized stables. We actually view them as some of our best customers as we fit right into the PSM or other forms of collateral for them, or maybe expand their potential market share. You know, Guy talked about this earlier, right? If you're just sort of focused on leverage and don't tweak the product over time, you sort of pigeonhole yourself into a smaller TAM. So I don't think it's one versus the other. I think they work hand in glove with one another.
Chris?
I think from our side, we think about how do we continually legitimize crypto and DeFi in general, and stablecoins really have the best product market fit thus far. So, let's keep building, getting these things out there. And as Guy already talked about, getting this kind of like composability of stablecoins is going to be important.
Bring us home, Guy.
Yeah, I don't know what to say outside of that. I think we obviously all quite bullish on the market from where we are now. I think we've actually seen this cycle. It's probably one of two things that crypto's actually found reasonable product market fit, especially for like a non-speculative use case. So I think we're just pretty excited to be part of that growth in the next few years. We think that the market gets much larger than $1 trillion in sort of the time that we're working within it, and we just want to be part of that growth with everyone else.
Awesome. Well, guys, thank you so much for taking the time. Thank you all for joining us.